Back to the debt debate and credit crisis. Financial experts all across the country are keeping an eye on the foreign financial markets right now to see what may happen when the Dow Jones opens at 8:30. Chris Stipes is live right now in our newsroom. Good morning, Chris.
Melissa, good morning to you. We wanted to get inside the head of a financial advisor, and we are lucky enough to have a very good one with us this morning. Lance Roberts. He's a talk radio show host, StreetTalkLive.com, also has his own financial advising company. Lance, first, let me talk about yesterday first. 634-point drop, the sixth biggest drop in the history of the Dow Jones Industrials. Surprised? You expected this, right?
Well, we've been expecting this for a while. Actually, back in April, we started advising clients to raise more cash and raise more fixed income, simply because you're looking at year-over-year declines in economic growth, looking at high unemployment, and all these type of things start to weigh on the economy. And stocks as a function, if you're investing in the markets, stocks as a function cannot be detached from the economy for very long, because the economy is what drives stock prices ultimately. So there got to be a detachment between stock prices and the economy, and those have to play catch up. That's what we're seeing now.
So I said I wanted to get inside your head. You wake up as a financial advisor. Obviously, people have trusted you with their money to make them money.
Right.
More pressure now maybe than ever before.
Right.
Well, not never before. We saw 2008. You got through that. You wake up in the morning. You get to the office. What are the things you're looking at? Obviously, what happened overnight in Asian and European markets.
Absolutely. And, of course, some of the things that we look at is we do look at see how markets react on a day-to-day basis relative to the news. But honestly, this means very little to managing money. The biggest mistake that investors make is watching the news and watching the media and watching the internet every day, tick by tick, because it leads to emotionally bad decisions. And you don't want to make decisions based on your emotion, right? Exactly. One thing that we try to show people, and from time to time, is that this was the peak of the market back in 2008. We were telling people back here to start selling assets and getting out of the market, because people tend to buy at the top of markets. They tend to sell at the bottom of markets.
And that's how you lose money.
That's how you lose money. So here we were telling people to sell assets here because we had broken some technical supports, some psychological issues had changed. And so we've been out of the market for the most part during this decline. But this is where we want to start looking to buy. Everybody's panicking now, trying to get out of the markets here. This is one thing we recommend that you don't do. You don't want to sell here. Now, the futures are up today, and we're going to see a little bit of a bounce, probably somewhere between 13 and 14 points today. And again, as we get this bounce, this is going to be an opportunity, if you haven't done anything, to raise a little bit of money in your portfolio, because this decline is probably not over yet.
And the overseas markets did better than they did the previous day. I mean, they were still down. Many of them, I know Australia went up a percentage point, but most of them down 1%-ish. Did better than expected. How does that directly affect what happens in the United States?
It doesn't, actually. It's pretty much vice versa. The international markets tend to follow what the U.S. market does. Okay. Remember, we're the biggest financial market on the planet, bar none. So pretty much what you'll see is yesterday's reaction of what you saw in the international markets were a reflection of what happened here yesterday. So today, if we wind up in the green at the end of the day, most likely you're going to see the international markets up overnight.
We hear that term crisis, financial crisis going on right now. Right. Is it really, or is it just the way the game is played, so to speak?
Well, going back to our chart that we just showed you a second ago, if I can get back to it.
And again, just to show viewers at home, this is 2008, the peak of the financial crisis. This
was your financial crisis. If you take this out of the equation for a second, this crisis part, what you saw here was a normal topping pattern. In other words, the markets don't go up all the time. They go up, they go down. And we talked about this a couple of weeks ago on talking about the ebb and flow of waves. As waves come in and waves go out. We had a wave that was coming in, and as the wave started to go out, we had plenty of opportunities to exit the market before the crisis occurred. This is not a crisis. This is simply an unwinding of a trade that we had going on for the last 2 years that's been driven by stimulus. The Federal Reserve has put in $5.1 trillion to drive the market to here. Right now, we don't have any of that. So today, the Fed meets, and we have the FOMC meeting today at 2 o'clock this afternoon. They'll make an announcement. Jackson Hole, the Economic Summit, is at the end of this month. So very likely, we'll see some announcement about federal support in terms of another stimulus program.
Okay, and you can stick around to continue to talk with us. We're going to talk with you at the top of the 8 o'clock hour. Lance is going to stay tuned. Markets open at 8:30 our time, so stay tuned for that. We're going to be here, and Lance is going to be here, gracious enough to stick around and give us some more insight. I want to learn more about these trends and patterns and more advice still to come for investors. Back to you guys.
What are your trusted financial investors doing right now as the market is getting ready to open? Chris Stipes is on the Market Watch with financial analyst Lance Roberts this morning. Hey, guys.
That's right, Melissa. T-minus about 27 minutes until the market's open. What's going to happen today? If I knew that answer, I could probably make a lot of money. I don't, but perhaps this guy does. This is Lance Roberts. He's a financial analyst, often on the show. Lance, they're coming in again.
Sure, absolutely.
So I want to get inside your head and get some insight in terms of...
That's a scary place.
It's quite challenging. What's the mindset of a financial analyst, a financial advisor, not just yourself? I know you can't speak for others. What's going through your mind right now as we're less than 30 minutes away from a market opening when we had such a sell-off yesterday?
A lot of hoping and praying we don't have another one today. That would be, that's the first start. No, what most people are doing right now is trying to figure out what's next. Are we in for further declines? And if so, how should we position portfolios? Or is the selling and the panic over with? We do have a lot of indicators currently that are showing that panics are reaching extreme levels. Now, again, being of remembering that we want to be buyers when people are scared. And this is the time. So you look for opportunities like this to be a buyer in markets when there's a lot of panic and what the old quotation is blood in the streets, and that's what you're seeing today.
You mentioned that one of the challenges I would imagine of your job right now is getting calls from clients saying, you know, what's going on with the market? You know, am I going to lose a lot of money? There's a lot of pressure on you to not lose that money, so you got to move things around. Give me some examples of some of the calls that you've taken from clients that are quite concerned right now.
Well, no, it's actually very interesting. We raised cash for clients and moved into fixed income back in April, so we've bypassed a large chunk of this decline. And yesterday we actually started buying a little bit into the markets, and of course the immediate calls we get is, why are you buying here? The world's coming apart. Haven't you been paying attention? And that's exactly what we want to hear from clients. We want clients to be afraid when we're buying, because that means we're doing the right thing with their money. When they're greedy and we're selling and they're upset because we're selling and they're worried about the market going up a little bit more, we're doing the right thing with money. Remember, we want to do the opposite of what people feel, because that's the right thing to do for your money.
I know a lot of your clients are nearing retirement age or already in retirement.
Right.
There was a figure I saw thrown out yesterday, like $16,500 was the average loss of a 401k. So what do you tell those older folks when they see that amount of loss in a day?
Well, that's it. And again, the biggest thing that you have to do when managing your money is not chase financial markets. The problem with chasing a financial market in general is that at the end of the day, this is what you have to avoid. These huge declines that take away a large chunk of your principal, when you're getting close to retirement, you cannot make up these type of losses. And even here, even with this rally, people did not get back what they lost 3 years ago. You don't have an infinite time horizon to retirement. You have to make sure and bypass the big chunk of these declines like there, like here, because you don't have time to make up that money. So being more cautious, more conservative, and being disciplined in your approach is what keeps you safe in markets like this. And if you can't do it on your own, hire an advisor to do it for you.
I'm looking up here on the Fox Business Network, and these are the Dow Jones futures up 115 points right now. How accurate are these generally?
They are accurate for about 15 minutes.
And then it could just change like that.
Exactly. No, what these indicators do, these futures do, is they give an indication of what traders are currently thinking about how the market's going to open. But once we get into the actual trading, where the computer programs kick in and start buying and selling, the game changes. And again, these declines like we've seen over the last couple of days, this is computer buying and selling going on. 80% of all trades today are run by computers. So as we began breaking these levels of critical support here and here, every time we break a level of support, these computer programs see that technical support break and they start selling more, and it feeds on itself. And that's why these drops, 500 points last week, 600 points yesterday, are so exaggerated, because of the fact that most of the programs are running the markets today.
All right, very good. And Lance is going to stick around for one more segment. Mike Iskovitz, who is our weatherman, but also quite a very, very good financial mind as well. He's going to come in here and talk to you at 8:30. Mike loves talking about this stuff, so that'll be, not that I don't, but Mike knows a lot more than I do.
Yeah, we get geeky.
So. they get money geeked over here. All right, let's send it back to you guys.
more on what the credit crisis means for the everyday consumer, we're going to head over to Mike Iskovitz. He's standing by with financial analyst Lance Roberts in our newsroom. Mike?
And there are two things that I want to pick Lance's brain about. One is computer trading, which you hit on before, which fascinates me like crazy. It makes us think of Skynet from Terminator, as you mentioned before. And the other is this Fed meeting that's going to be held later today. So let's talk about this computer trading. I remember watching the TV back in May of 2010, the so-called flash crash, which was what, right there?
Right there.
And the Dow dropped 1,000 points intraday. And a lot of that was driven by computers. Do you think these giant crashes the last two trading sessions have been computer-driven?
Well, it's a big function of that. 80% of all the trading that occurs on a daily basis are now driven by computers. And what happens is these computers basically have algorithmic programs written into it, and they're looking for specific identifiers, breaks of critical support, breaks of a trend line, and that triggers selling. And that's why you'll see these big accelerations during the middle of the day as a trend line is broken or support level is broken. All of a sudden the market will accelerate to the downside because all the computers are kind of looking at exactly the same set of data. And that's why you've seen lately, in particular over the last couple of years, and even go back to the financial crisis, these declines are much bigger than they've been in the past because more and more of the volume now is driven by computers because, you know why? The retail investor gave up on the markets back over here. More and more retail investors are sitting in cash, very similar to what we saw after the Great Depression. After a while, retail investors, when they lose enough money, they just quit investing.
Yeah. That's scary that robots are running the show right now because it makes you think that if you have your money like in mutual funds, not something you can sell at the drop of a hat, that you could lose your whole life savings and due to some computer glitch.
You know, and again, you're not going to lose your whole life savings, and I don't want to scare
It was more
people.
dramatic for me to say it that way.
I understand that, but you know, it's a point. But even back over here, if you remember back during the financial crisis, people were literally concerned that the market was going to end. They were going to lose everything, and those are generally great buying opportunities.
And it was.
And it was. And now, that's what you're looking for.
Now let's talk about this. The reason we had this huge turnaround here in March of '09 was that we started quantitative easing and stimulus.
That's correct.
And then we had another round of quantitative easing in the summer of last year. The Fed is meeting again today. Based on what they say, that could spark a rally, right?
Quantitative easing 3 will start somewhere right in here.
It could be. Okay, so if we hear on the news later today that the Fed Chairman Bernanke says, okay, we're going to start this easing, which means pumping money into the system. What does that mean for stocks?
Well, it'll mean that stocks eventually go up. But let's talk about this quantitative easing 1 and 2 very quickly here. $5.1 trillion were injected into the system. We got a stock market rally. The economy grew by $600 billion. So in other words, we took $8 of stimulus to create $1 worth of economic growth. Stimulus is not good for the economy. It won't create jobs. It won't heal the economy. It won't get America back on track. It will drive asset prices.
It's kind of like getting a shot of steroids or something. It'll help you maybe for a few days.
No, it's more like heroin. And that's what Wall Street's been addicted to.
You need more and more and more.
Exactly. In order to keep markets driving, they need more of their addictive stimulus.
Now, I checked gold earlier this morning. It was approaching $1,800 an ounce.
Yes.
And a lot of that is kind of driven by this quantitative easing, right? Because the value of the dollar goes down and gold goes up. Could that happen again?
Sure, absolutely.
How high could it go? I mean,
well, it's 2,000.
Yeah.
Honestly, gold is a fear trade. And whenever you have fear in the markets like you're seeing now, money moves into where? Treasuries. And we saw that yesterday. You know, we had this big debt downgrade. You know, we're going to go down the tubes. And, of course, money went in. We had an 8% decrease in interest rates yesterday. It's huge in one day. So money goes into treasuries, safe havens of cash, and gold. It doesn't provide you a real return. There's no income from it, but it's a fear trade. And the gold trade goes back to the Depression and World War II when you had to have gold to bribe the border guards to get across the border. We don't need that anymore, and gold won't buy you a cup of coffee, but it's good to have. Makes people feel better.
Very interesting. Well, we're going to see what happens today because just to wrap things up, Lance was telling me just technically looking at the charts, we may see a bounce here.
That's right.
And if we do see a big bounce, it might be an opportunity to sell some stuff that you couldn't get out of before.
Exactly. Yeah, try not to panic sell.
Don't panic.
That's right. And try to sell when you have a little bit better opportunity.
Good deal. Hey, we're looking out for your money here, baby. We're going to save you some bucks. All right, back to you guys in the studio.
You know, it's amazing how during just the course of this particular conversation between Lance and Mike, the market dropped about 20 points. The arrow's still pointing upwards, the green arrow's still pointing upwards, and there are a lot of hopes, but it dropped. Ooh, it was above 100. Now it's at 57.07, 59.68. very, very changing as the hours go. And we will let you know a little bit more about this as we continue to talk about your money later this morning. Keeping their fingers crossed. Thanks a lot, Doug Luzader in the nation's capital. And now to what the financial experts are saying about today's open. Chris Snipes is with the host of Street Talk Live, Lance Roberts. Chris.
Jose, that's right. Lance Roberts has been with us all morning long. Lance, thanks for sticking around. First, I want to get your reaction. The market's opened just more than 30 minutes ago. Right. Off to a great start, but it's still been very volatile, up about 184 points right now.
Well, that's right. And of course, you know, what we're seeing here is, and we've been talking about this last couple of days, markets have gotten extremely oversold on a short-term basis. And something that we've been, that is important is not to panic sell. When there's big sell-offs, people tend to try to go out and sell stuff in their portfolio without really thinking about it. So like, oh my gosh, things are going down. That's generally the worst thing to do. You know, you don't want to, you know, sell low and buy high, and that's typically what causes investors to lose money over time. So in times of panic, last few days I've been sitting there saying, don't panic. We're going to get a bounce. Well, we're getting a bounce today, and we'll may get a bounce for the rest of this week. We've got the FOMC day today, which has been Bernanke, and they're going to be probably talking about some form of support for the market, some type of quantitative easing, maybe part 3. We'll see what they say this afternoon. But that could give some support to the markets over the next few days and give you a better opportunity to raise some cash. Most likely, we're not going back to highs anytime soon, so selling into rallies makes a lot of sense.
Yeah, that was going to be my next question. I mean, the Federal Reserve policymakers, as we talked about, Doug Luzader, you just spoke about it with Bernanke meeting this afternoon. A lot of this is just about confidence, investor confidence, and this could potentially provide that.
Exactly. Again, you know, if you look at quantitative easing 1 and 2 that we've had so far, we had a great market rally from these extremely oversold lows back in 2008. The economy didn't recover much at all, actually. In fact, you ask the average American, they still feel like we're in a recession. So quantitative easing will very likely help recover the market somewhat. Probably won't do a lot for the economy, but at least it gives us a better opportunity, other than today or yesterday, to be selling stuff.
And you've talked about it a lot. You say a lot of people feel we're still in a recession. I guess officially, not really, but you're a firm believer that we are going to get this double dip.
Oh, yeah, absolutely. Look, statistically, we're not in a recession. The only reason we're not in a recession now is because we had quantitative easing 2 back last summer. We would have been in a recession now if it had not been for that. If we don't have any type of quantitative easing announced today or by the end of the month at Jackson Hole at the Economic Summit, we'll be in a recession by the end of the year. The trends in the economic numbers already tell us that.
I know a lot of financial advisors like yourself are fielding calls from clients right now saying, my 401k, I just lost, you know, X amount of thousands of dollars. Of one, I threw this number out earlier, $16,000 is said to be the number of the average amount lost in the 401k just in the last couple of days. What do you tell people right now about what they're supposed to do? Don't touch it, right?
Exactly. Don't do anything now. But the thing is we've been advising clients since April to have more cash and fixed income. Remember, your 401k plan is your retirement money. That's your, don't screw up that money, because if everything else goes wrong in your life, at least you have that for retirement. So be very conservative with that. And so you want to carry more cash and more fixed income in there right now until we get through this period of turbulence. And look, it's not just about the market and the debt ceiling here. We've got Greece. Italy is on the brink of collapse. We have a variety of issues in the Eurozone, and we've got a debt problem here. So all this is going to weigh on the economy and the markets going forward.
Very quickly, I want to mention your radio show, which is on AM 700, 6 to 8 p.m. every night, Monday through Friday. What are the people saying on Street Talk Live that call in and talk to you? What is the overwhelming feeling there?
The overwhelming feeling is basically, what do I do? I'm trapped into this. How do I get myself back out of it? And again, we do a lot of work on our website as well at streettalklive.com, which is to talk about what to be doing with your money right now. We post a blog every day talking about these very same issues. What should you be doing? Where should you be positioning yourself? And what should you be looking to do next? And the next thing is going to be a rally, probably to 1,200 on the S&P 500. There's a number for you. We get back to around 1,200 on the S&P 500 index, be a seller. Raise some cash, buy some fixed income.
Very good. Lance Roberts, appreciate the time as always.
My pleasure.
Back to work. Thanks. Back to you guys in the studio.